Hello students, this is Professor Taramati Nakod from Government First Grade College, Kundgol. Welcome back to Financial Accounting 2. Today we are going to discuss the treatment of normal loss and abnormal loss under cost price method. The treatment of normal loss and abnormal loss under cost price method. So sometimes there may be normal loss as well as abnormal loss in the goods consigned. In that case, the abnormal loss is calculated in the usual manner at cost plus proportionate non-recurring expenses incurred up to the stage of such loss. So we have discussed it in a previous class how to do calculation of abnormal loss. Then this amount should be deducted from the total cost plus non-recurring expenses. The value represents the value of goods available for sales. Now, let us discuss this with the help of a problem. Amit consigned 2000 kg of oil at rupees 15 per kg. He paid rupees 3000 as freight and insurance, etc. So, freight and insurance is a non-recurring expense. Then 200 kg of oil lost in transit. Puneet sold 1320 kg of oil incurring rupees 200 as selling expenses. He reported that there was a normal leakage of 40 kg. Now we have to understand that in the same problem there is an abnormal loss of 200 kg plus normal loss of 40 kg. So when both are there, now let us see how the calculation of abnormal loss and closing stock is done. So as I said in the beginning of the class, in a normal way we have to do the abnormal loss calculation. So how many number of kgs are lost in transit is 200 abnormal loss, 200 kg into cost per kg. Total is 3000. Add proportionate expenses of consignor up to the date of loss. So we know that he has spent rupees 3000. So proportion of 3000, that is, if you do 200 divided by 2000 into 3000, then proportion comes to 300 rupees. Then total of the abnormal loss is cost plus proportionate non-recurring expense, that is 3300. Okay. Then calculation of closing stock. Now you have to be very careful when you are doing this. When you are doing a calculation of closing stock when there is a normal loss, you have to start with the beginning. That is, you have to see what is the total cost price of the goods sent. That is 30,000. Total non-recurring expenses added 3000. So total comes to total cost of 2000 kg was 33,000 inclusive of non-recurring expense. From that you have to deduct the abnormal loss. So just now we have calculated 3300. So from 33,000 if you deduct 3300, it is 29,700. Next, therefore cost of 440 kg, okay, is equal to 440 divided by 1760. Why we have taken 1760? Now let us see. From 200 kg, sorry 2000 kg, 200 kg was an abnormal loss. So how much should be available for sale after abnormal loss? Should be 1800. But there is a normal loss as well. When there is a normal loss, it should be deducted from this 1800. So now you can see how much is available for sale is 1760. So instead of writing for 1800 kg, this is a cost price of 1760. So 29,700 is used for calculating closing stock. So 440 divided by 1760 to 29,700. Then it is 7,425. So now this 440, how you have arrived? The calculation is given. total 2000 kg was there. Sorry. Then from that, abnormal loss deducted, normal loss deducted, sales deducted. Then you have arrived at 440 kg. Now let us take one more problem. Belgavi Oil Mill consigned 1000 kg of a sweet oil to Raju of Dharwad. The cost of oil was rupees 15 per kg. The consignor paid rupees 4,780 as a freight and insurance. During transit, 100 kg of oil was accidentally destroyed. So accidentally destroyed means it is a abnormal loss, for which the insurance company paid rupees 1,600 in full settlement for claim directly to the consignor, means recovery of abnormal loss up to 1,600 rupees. Raju took delivery of a consignment and accepted the bill drawn on him for rupees 10,000. He sold 690 kg at rupees 30 per kg. The expenses being go down rent rupees 163, advertisement rupees 300 and salesman salary rupees 400. He is entitled to a commission of 3% and 2% del credit commission, means total you are paying him 5% commission on the sales. Raju reported a loss of 10 kg due to normal leakage. Now you can see there are two types of loss. Abnormal loss 100 kg, normal loss 10 kg. He also settled the amount due. Prepare the necessary accounts in the books of both the parties. Okay, so in that you have to make first calculation of abnormal loss, then closing stock, then we are going to prepare the accounts in the books of both the parties. Okay, now first we'll go for the calculation of abnormal loss. So first we'll see what is the price of the abnormal loss. So here 100 kg was lost in transit and cost per unit is 15. So it is 1,500. Proportionate of non-recurring expense. So total non-recurring expenses by the consignor is 4,780. Okay, for 100 kg it is into 100 divided by 1000. Then it comes to 478. So once you add proportionate expenses to the cost of abnormal loss, you will get value of abnormal loss as 1,978. Then in the same way you are going to calculate the closing stock as well. So when you are making the calculation of closing stock, you have to see cost price of goods consigned, total cost, that is 1000 kg into 15, so 15,000. Add non-recurring expenses, total expense for the consignor 4,780. So the total value comes is 19,780. So from this 19,780, abnormal loss as calculated, that is 1,978 to be deducted. Once you deduct this from the total value, you will get a value of a stock to be sold, that is 17,802. Now let us see for how many kgs this value is applicable. Now here 1000 kg was supplied, sent, and abnormal loss of 100 kg. Then it should have been 900 kg. Why you have written 890? It is because there is a normal loss of 10 kg. So instead of taking 900, you should take it for 890 kg. Right? So this is used while making the calculation of closing stock. Now you have to take this total 17,802 into how many stock were there in the closing. So in a closing stock you can see goods sent 1000, abnormal loss 100 kg deducted, 690 sales deducted, 10 kg normal loss deducted. Then in closing stock it is remaining is 200. So divided by total it is 890 kg. So once you do this, the value of closing stock is 4,000 rupees. Okay, now we'll take the accounts in the books of Consignor. Okay, so here in the books of Belgavi Oil Mill, you are going to write consignment account. So in a consignment account, you have to write on the debit side first goods sent on consignment, that is 15,000. Then expenses by the consignor, that is 4,780. So if a consignee does any expense, you have to write to consignee or Raju. So he has spent go down rent 163, advertisement 300, salary 400. So the total comes to 863 is a expense by the consignee. Then you have to pay him a commission. So there are two types of commission. Okay, so total commission payable to him 3 plus 2, that is 5% of total sales. Now let us see, first the total sales is 20,700. From that 20,700 you have to do 5% commission. So 5% commission is 1,035. Then abnormal loss you have already calculated 1,978. So by abnormal loss account. Then closing stock also is calculated. So closing stock is 4,000 rupees. Now you can see the total of credit side 26,678. Then you deduct these debit items. You are going to get a profit of 5,000 rupees. Okay. Now you are going to prepare a consignee account. So in that, first you have to write to consignment account for the sale made by him 20,700. Here on the debit side he has accepted bills, so 10,000. Then consignment account for all expenses, that is 863 as we have done it in a earlier account. Then consignment account, it is for the commission 1,035. Then you have to take the debit side total 20,700, deduct all these items, then the settlement amount is 8,802. So it is by bank account. So how this account is to be closed? By making the settlement. Then abnormal loss account you have to prepare. So here you have shown abnormal loss, that is credit side of your consignment account. In abnormal loss account, it is on the debit side. Consignment account 1,978. Now let us see, from 1978 you have received 1,600 as a claim for the from the insurance company. Then the total loss what you are going to get out of this is the difference amount. Okay, so if you take this different, total loss was 1,978. Claim received is 1,600. So the remaining amount 370 is a loss which is to be transferred to profit and loss account. This is called unclaimed amount of abnormal loss transferred to profit and loss account. Okay. Next we have seen this calculation. Now in the books of the consignee you are going to prepare the consignor account. So here the consignor is Belgavi Oil Mill account. So now in that they are going to show what are the expenses done by the consignee for the consignment. That is to bank all the consignee expenses. That is 863. Commission to him, that is 1,035. Bills payable 10,000. Then total sales what he has paid is 690 kg into 30. So it comes to 20,700. So from this total sales of 20,700, he deduct all his expenses, commission, etc. Then he will pay the amount of 8,802 to the consignor through bank draft. Okay students, I think this is very easy to understand. Here in this problem we have learned how to treat the normal loss and how to make the calculation of abnormal loss and closing stock when both normal loss and abnormal loss are given in the same problem under cost price method. We'll see you in the next class with new problems. Till then, take care. Thank you.